The single biggest predictor of whether a trader gets better over time isn't strategy, capital, or screen time. It's whether they review their trades. The ones who improve all journal in some form, the ones who plateau all skip it, then wonder why they keep repeating the same mistakes. Today we'll fix that with a process, what to actually log, the math that reveals whether you have an edge, and the warning sign your edge is decaying, even when your account looks fine. Forget the feelings diary, that's not what a trade journal is for. For things, every trade, no exceptions. 1. The setup name, pullback to MA, breakout, double bottom, whatever your repeatable list calls it. 2. The exact entry, stop, and target prices with the chart screenshot. 3. The R multiple result, how many times your initial risk you actually won or lost. 4. A 1 to 5 score on how well you followed your own process, regardless of the outcome. That's it. Anything more and you'll stop doing it by week 2. This is the mental shift that changes everything. You score the process, not the outcome. A trade where you followed your rules exactly and lost is a 5 out of 5 process trade. Keep doing it. A trade where you broke your rules and made money is a 1 out of 5. That habit will bankrupt you. Markets are probabilistic. Any single trade is noise. The only thing you control is execution. So that's the only thing worth scoring. Separate those two and your psychology stops swinging with your P&L. Once a week, plot the R multiples of every trade you've taken. Some will be plus 2R winners, some minus 1R losers, some break even. The average, that's your expectancy, your edge, expressed in pure risk units. If your average R per trade is positive, you have a real edge that compounds over time. If it's around 0, you're gambling with extra steps. If it's negative, the math is telling you to stop trading and rework the strategy. The equity curve smooths a lot, the R distribution doesn't lie. Here's the warning sign almost nobody catches. Your account is still growing, but the average R per trade has been quietly drifting down for the last 3 months. That's edge decay, and it's invisible if you only watch P&L. Maybe the market regime shifted, maybe you're taking lower quality setups, maybe you're sizing up too fast. Whatever the cause, the math is screaming at you while the dollar number lies. The R multiple distribution is your early warning system. Watch it like a hawk. The other gift of a journal is what it reveals about you specifically. Tag your trades by setup, then look at the R multiple per setup. You'll find that 1 or 2 setups carry your whole edge, and 1 or 2 are quietly bleeding you. Cut the losers from your rotation, double down on the winners, and you've just optimized your strategy with data that nobody else has, because nobody else trades exactly like you. That's the lever the journal gives you and nothing else can. So, skip the feelings, log the process. For fields per trade, weekly review of the R multiple distribution, and you have a clear, honest read on whether you have an edge and whether it's growing or decaying. Score yourself on execution, not outcome. The traders who do this quietly compound, the ones who don't keep repeating the same mistakes with bigger size. Subscribe for the full method and trade your own plan. Education, not financial advice.